Okay, so what if I told you that the absolute best piece of investing advice you could ever receive boils down to treating the stock market exactly like finding a romantic partner? I know, it sounds totally crazy, but this advice actually comes from a highly successful millionaire, and it completely demystifies the incredibly intimidating world of Wall Street. So, welcome to this explainer. Today, we're going to break down exactly how to invest in stocks, and we're going to do it using some highly sophisticated, completely adorable stickman doodles to make everything crystal clear. No jargon, no confusion. Let's get into it. Here's a quick roadmap for what we're covering today. 1. Investing is like dating. 2. The balance sheet cookie jar. 3. Income statements and profitability. 4. Checking the cash flow. 5. Beyond the numbers. And finally, 6. Building your investment portfolio.
All right, section 1, investing is like dating.
Okay, let's dive into this. When you buy a share in a company, you aren't just grabbing a piece of paper or some digital ticker symbol. You're actually becoming a part owner. You are entering a partnership, and just like any relationship, you want it to be happy, long, and successful. But to get there, you need a very distinct strategy. You basically have two main paths to choose from here. First up is technical analysis. This is mainly for short-term day traders who are trying to predict charts. And if we're being completely honest, many who use this strategy are essentially glorified gamblers. In fact, over 95% of day traders actually lose money. No thanks. On the other hand, we have fundamental analysis. This is what we're focusing on today. This approach is literally like being a detective. You review the financials, you check out the brand value, and you look for a solid 3 to 10-year growth period. We want to secure your long-term financial future, not just chase a quick buck.
Moving right along, section 2, the balance sheet cookie jar. So, now that we've decided to be fundamental detectives, we need to start checking out a company's dating profile, so to speak. And in the financial world, that profile is known as the balance sheet. Now, I know reading formal definitions can make your eyes glaze over, but a balance sheet is simply a financial statement that provides a snapshot of a company's position at a specific point in time. It details their assets, liabilities, and equity. That's it, just a snapshot. But to make it even easier, we're going to use a super simple, doodle-friendly analogy to really bring this concept to life. I want you to imagine the balance sheet as a giant cookie jar. At the very top of the jar, you've got your current assets. These are the cookies you can reach in, grab, and eat right now. For a company, this means cash or things easily turned into cash within 12 months. Dig a little deeper and you find the long-term assets, like a company's physical headquarters or their heavy equipment. Then we have intangible assets. These are kind of like the invisible ingredients that make the cookies taste so amazing. Things you can't physically touch, like patents, trademarks, and brand goodwill. Finally, we have liabilities. These are the cookies in your jar that you've already promised to give away to your friends because, well, you borrowed their ingredients. And this brilliantly illustrates exactly what to do with that cookie jar using real-world math. You just take the current assets and divide them by the current liabilities. Take a look at Coca-Cola, for example. They have roughly $26.7 billion in current assets and about $23.5 billion in current liabilities. If we do the math, that gives us a risk ratio of 1.13. As a general rule of thumb, anything above 1 is exactly what you want to see. It literally means Coca-Cola has $1.13 in short-term assets for every single dollar of short-term debt. They've got enough cookies to pay back all their friends and still have some left over for themselves.
Section 3, income statements and profitability. So, the dating profile looks great, but before a relationship gets really serious, you definitely want to do a background check on their past track record, right? Well, for a company, that record is their income statement. And here is how you read that report card step by step. Let's pretend you're running a custom t-shirt shop. First, you have your total revenue. That's all the money you took in from sales. Next, you subtract your cost of revenue, because you obviously can't make t-shirts without buying fabric and ink. Then you subtract your operating expenses, which is the money you spent on things like marketing campaigns and paying your staff. What you're left with at the very end of all that is your operating income. And the cool thing is, whether you're a tiny little t-shirt shop or a massive global giant like Coca-Cola, figuring out what you actually get to keep at the end of the day works the exact same way. Now, take a look at this massive number. If you take Coca-Cola's operating income and divide it by their total revenue, you get a profit margin of about 25.7%. Why does this matter to us? Well, a really good rule of thumb to remember is that a 5% margin is generally considered low, 10% is considered healthy, and 20% or above is highly profitable. So a nearly 26% margin, Coca-Cola is doing great. But quick side note, profitability isn't the absolute only thing to look at. Sometimes newer companies, like Amazon back in its early days, won't show a profit for years simply because they are aggressively pouring everything back into growing the business.
Section 4, checking the cash flow.
Listen, it might not sound terribly romantic, but if you're getting involved with someone, you absolutely do not want a partner who is terrible with money. Money issues ruin relationships, and trust me, they ruin companies too. That's exactly why we check the cash flow statement. It shows the actual cash coming in and going out, and it's divided into 3 really easy parts. First, operating activities, that's the money from day-to-day business operations. You definitely want this number to be positive. Second is investing activities, which covers buying new equipment or acquiring other companies. Now, here's a fun fact. A negative number here can actually be a fantastic sign. It often means the company is heavily reinvesting in its own future. Finally, we have financing activities, which shows the company borrowing money and paying out dividends to its shareholders. So the absolutely crucial point here is this warning. Be extremely cautious of companies with negative cash flow that rely heavily on borrowing while still paying out high dividends. To put it into perspective, it's exactly like someone winning the lottery, immediately quitting their job, but continuing to buy all their friends' wildly expensive sports cars. It is completely unsustainable, and eventually, the cash is simply going to run out. Huge red flag.
Section 5, beyond the numbers.
Have you ever met someone who looked absolutely perfect on paper, but when you met them in real life, there was just zero spark? Well, it is the exact same with stocks. We have to move past the spreadsheets and look at the company's real-world footprint through what we call qualitative analysis. Let's compare 2 giant tech companies, Apple and Xiaomi. Apple has incredibly strong worldwide brand recognition and incredibly deep consumer trust. In the tech market, they are basically the irreplaceable king on a chessboard. Everything else moves around them. Xiaomi, on the other hand, is a massive player in China and emerging markets, but if you mention them to an average person in the UK or the US, you'll probably just get a blank stare. Strong brand recognition builds deep customer trust, and for you as an investor, that fundamentally minimizes your risk when they face stiff competition.
You also need to investigate a company's leadership and how susceptible they are to public sentiment. Let me give you a wild example. Back in 2016, then-President-elect Donald Trump tweeted about the F-35 program, which is a major project by Lockheed Martin, stating that the cost was simply out of control. Now, regardless of where you fall on the political spectrum, the financial impact of this single public statement is undeniable as a matter of historical record. That one tweet caused Lockheed Martin stock to instantly nosedive, wiping out nearly $4 billion in market value in a single day. $4 billion. It vividly demonstrates how heavily a stock's stability can rely on external leadership dynamics and high-profile public sentiment. And because of that kind of volatility, you have to protect yourself against acting purely on emotion when bad news strikes. Just look at this timeline. In March 2018, the whole Cambridge Analytica data scandal broke. Within 10 days, Facebook's stock plummeted by 18% because people absolutely panicked. The 24/7 news cycle acts just like supermarket toilet paper panic buying. People sell out of sheer fear without thinking it through. But if you look at that stock today, it's up more than 200% from that initial drop. The lesson here? If you do your foundational research, you can hold strong and avoid the dangerous trap of emotional panic selling.
Section 6, building your investment portfolio. Okay, so the dating phase is officially over. Now it's time to settle down and explore the 2 main personalities of stock partners that you can commit to, so you can build a really well-rounded long-term portfolio.
First, we have value stocks. These are your big, stable, highly established companies. They generally have lower relative prices and they pay out regular dividends. Think of the companies people rely on no matter what the economy is doing, like Procter & Gamble or Berkshire Hathaway. Then we have growth stocks. These are much more volatile. Investors expect them to grow rapidly, so they're priced higher up front. They rarely pay dividends because they are furiously reinvesting all their money back into the business to keep growing. Think of innovators like Amazon or Tesla.
Now, what's really interesting about this is if you're ever struggling to tell which category a stock falls into, here is your ultimate cheat code: the PE, or price to earnings ratio. A typical average PE ratio sits right around 20 to 25. As a quick general rule of thumb, if the number is below that range, you're more than likely looking at a value stock. If it's above that, you're looking at a stock that investors expect to have very high future growth. Just remember, this does vary a bit depending on the specific industry, but it's a great little cheat code to keep in your back pocket.
Finally, you need to mix and match these stocks to protect yourself. You can't put all your eggs in one basket, right? This is the absolute golden rule of diversification. You should never ever have more than 5% of your money tied up in one single stock, and no more than 20% in a single sector, like just technology, for instance. The remaining chunk of your money should be distributed widely. You want to aim for at least 25 different stocks spread across 5 different sectors. By doing that, if one stock takes a sudden, unexpected dive, the rest of your relationships are right there to balance things out and keep your overall portfolio perfectly healthy.
Well, we have definitely covered a lot of ground today. From treating your investments like a long-term relationship, to digging into the cookie jar of the balance sheet, to holding your nerve when the news cycle panics. The tools are all right here in front of you. So the only question left to answer is, are you ready to stop gambling with your financial future and start acting like a true financial detective? It's time to dive into the research, find those high-quality partners, and start building your long-term wealth today. Thank you so much for joining me on this explainer, and happy investing.